March has entirely reshaped the narrative and marks the biggest strategic blunder for the Trump administration. Let's dive right in. Now, coming into the year, we highlighted that declining cooperation on trade policy was very likely to translate to rising geopolitical tension, leading to a more fragile global backdrop. Now, did we anticipate the developments in Venezuela, Mexico, and Iran to escalate in the first 3 months of the year? Of course not. Yet it seemed obvious to us that if nations weren't cooperating on global trade, conflict overall was very likely to rise. In March, that risk moved from theoretical to very much real, and investors have responded accordingly. For much of the past year, markets have been driven by a fairly consistent set of themes: falling inflation, the expectation of rate cuts, and continued leadership from large cap technology, particularly related to artificial intelligence. In March, that framework began to change, and it wasn't driven by earnings or economic data alone. It was, in fact, driven by geopolitics. The escalation in the Middle East involving Iran quickly became the dominant driving force. It wasn't just another headline, it had direct and immediate implications for global energy markets. With disruption risks around the Strait of Hormuz, one of the most critical arteries for global oil supply, energy prices moved sharply higher. Oil surged well above recent ranges, with WTI now sitting at $100 a barrel, with Brent crude sitting around $110. When energy increases dramatically, it doesn't stay isolated, it feeds directly into inflation expectations. This does bring us to our second key development. As energy prices moved higher, the market began to reassess the path of inflation and, in turn, central bank policy. Earlier this year, there was a strong consensus that central banks, Bank of Canada and the Federal Reserve, would be easing policy in 2026. But in March, that confidence weakened. Markets have repriced those expected rate cuts. Central banks have in fact concurred, reinforcing that caution. With sticky inflation and now potentially reaccelerating due to energy, it becomes much more difficult to justify easing policy prematurely. It is unfortunate when geopolitics become the driving force, because these events can change direction on a dime. With that in mind, we have reduced our rate cut expectations for this year from 3 cuts down to just 1, expected later this year in September, versus our earlier expectation of July. Shifting gears to equity markets, which felt the pain in March, the S&P TSX, S&P 500, and Euro Stoxx 500 all dropped between 7 and 8%. At the same time, beneath the surface, markets were undergoing an important rotation. We saw a clear shift in leadership. Energy, materials, and industrials began to outperform, alongside more defensive areas like utilities. Meanwhile, some of the areas that have led markets for the past 12 to 18 months, technology and consumer discretionary, lag significantly. This is consistent with a broader transition away from those growth-led leadership toward more cyclical and real asset-oriented sectors. Commodities more broadly were also a major part of the story. Oil, which we've discussed, was the most obvious driver, but it wasn't alone. Gold had been on a strong run and peaked around $5,400 an ounce, and has since experienced a sharp and abrupt pullback, now sitting around $4,600. This highlights just how volatile these markets can be, particularly when positioning becomes crowded. Similarly, silver, which peaked around 115, now sits around 73 per troy ounce. The key takeaway here is that commodities are once again playing a central role in driving market outcomes. That's a meaningful shift from a market that, until recently, was primarily being driven by technology and AI-related themes. As all of this unfolded, the growth outlook began to soften. Energy prices act as a tax on both consumers and businesses. When you combine that with still elevated interest rates, you start to see increased pressure on economic activity. The result is a more challenging backdrop, where inflation risks are rising and growth expectations are being revised lower. This is where the Iran war becomes President Trump's biggest blunder yet. The U.S. midterm election is fast approaching on November 3rd, and the political math has shifted materially. Republican odds of holding the House have largely evaporated, and what was a viable path for retaining the Senate is now increasingly at risk. The Republican midterm campaign was built on affordability, but the war has done the exact opposite. Energy prices have surged, with U.S. gas moving from roughly $3 per gallon pre-conflict to sitting around $4 today, a 30% increase. This isn't a partisan view, it's a positioning reality. The administration has effectively sacrificed multiple chess pieces on the board, likely losing the House, jeopardizing the Senate, straining alliances, further weakening NATO cohesion, and exacerbating a very affordability crisis it was running against. Is there an off-ramp? Possibly, but it likely requires de-escalation of the war led by Trump. Even then, the damage may already be done. So when we step back, March marked a shift in what is driving markets. We moved away from a market defined by disinflation and rate cuts and concentrated tech leadership toward one increasingly influenced by geopolitics, energy, inflation, and broader sector participation. From a positioning standpoint, this reinforces the importance of diversification and discipline. Environments like this one tend to reward thoughtful balance across sectors, asset classes, and across different economic outcomes. While periods of transition can create volatility, they also create opportunity. With that in mind, how did Matco position and adjust our portfolios? In Matco's global equity strategy, we trimmed and took profits on a basket of technology holdings in January, which had performed very well. In March, we added a few companies to the portfolio: PTC, a global leader in product lifecycle management, TransUnion, an American consumer credit reporting agency, and Accenture, a multinational technology consulting company headquartered in Dublin. Now, in the opportunity strategy, we added to Kits Eyewear, a long-term consumer-based holding of ours. Kits has done very well for us since we entered the name in 2023. This year, the stock price has pulled back enough to warrant adding to the position. We also trimmed Valeura Energy, which also performed very well. Lastly, we added a new name, Meditech, a UK-based technology company. In the diversified income strategy, we implemented a targeted butterfly trade designed to improve portfolio efficiency. In simpler terms, we reduced exposure to longer-dated government bonds and a short-term corporate bond while adding to bonds in the 9 and 10-year range. This adjustment increased the portfolio's overall yield, improved the quality of our income stream, and reduced sensitivity to rising inflation. In short, we were able to enhance the portfolio's income while maintaining a disciplined approach to risk. We have also added a 5-year corporate bond issued by Dollarama. While not a flashy name, this company benefits from strong and consistent management and a business model that has proven highly resilient through times of economic disruption. We spent the month actively under the hood of the portfolios, fine-tuning their engines. Despite the pace, I did manage to get through my monthly read. Fortunately, it was a bit of a lighter one. In March, I read The Wealth Ladder by Nick Maggiulli. The book reframes wealth building as a progression through distinct financial stages, as in literal wealth dollar value benchmarks or thresholds. Nick frames each stage with its own priorities, risks, and decision-making framework. Rather than focusing solely on investment returns, it emphasizes how your strategy should evolve as your personal balance sheet grows. The key takeaway is that successful investors don't just invest differently, they think differently at each stage. It's a practical guide to aligning your financial decisions with where you are today and where you want to go. One of my top anecdotes from the book: money is much like the oxygen masks on an airplane. Please ensure yours is secure before assisting others. Now, it's a bit of a cheeky metaphor, but there is some truth and value in this statement. My top fundamental concept from the book, which I do encounter often with investors and clients, is the importance of distinguishing between taxable and non-taxable sources of savings. As investors progress through their accumulation years, it's common to feel increasingly wealthy as corporate and registered accounts grow in value. However, equal if not greater attention should be paid to building a pool of non-registered or after-tax capital. This not only enhances flexibility and tax efficiency in retirement, but it more accurately reflects true wealth. In many cases, it is only once this pool of meaningfully established that incremental pre-retirement spending should be considered. Now, regardless of where you are in your wealth journey, there is something in this book for everyone. I do recommend it, but primarily to those who are in the earlier phases or stages, as they're more likely to engage with the material. It's more focused on wealth strategy than investment markets per se, and I do often prefer the latter. Overall, I gave it a 7.2 out of 10. That's it for this month's edition of Read Between the Lines. Stay tuned for next month, and happy reading.